Is the space stock in a fatal downward trend flashing these massive sell signals? Or is it a strongly undervalued buy that the market is just completely mispricing?
Yeah, that's the big one.
Right. I mean, that is the multi-million or honestly maybe multi-billion-dollar question that we are staring at today. We're doing a deep dive into Sidus Space Inc., ticker symbol SIDU.
It's a wild one.
It really is. And look, before we get into the weeds, you need to hit the like button, subscribe to the YouTube channel, and leaving a comment is basically compulsory at this point.
Absolutely.
Your feedback is literally what shapes these deep dives, so we need to know where you stand as we unpack all this.
And, let's just set the ground rules right up front, especially with a stock moving like this one.
Good call.
What you're listening to today is a purely analytical, natural debate. We're looking strictly at the market data, the technical charts, and the recent SEC filings. Absolutely no financial advice is being given here.
Zero.
We're just digging into a highly complex situation so you can make your own informed decisions.
Always do your own due diligence, right? Okay, let's unpack this because, I mean, if you look at the timeline for Sidus Space, anyone holding this stock probably has severe whiplash right now.
Oh, definitely.
As of today, April 23, 2026, the stock settled at $3.71. That's an 8.51% drop just from the previous close.
Which hurts.
It hurts. But the 52-week range is where the story really lives. We are looking at a 52-week low of 62787 pence, which is deep in penny stock territory, and a 52-week high of 599 cents.
Right.
That is just a massive, violent swing. Why are we seeing this right now?
Well, what's fascinating here is that the volatility isn't happening in a vacuum. The immediate catalyst for this current plunge down to $3.71 is the registered direct offering they closed just yesterday, April 22nd.
Right.
They raised $58.5 million by pricing new shares at $4.35 apiece.
Okay, I have to push back on the management's timing here.
Go for it.
We had strong momentum earlier this month, right? The stock was flirting with that $6 mark, and then they just dropped this $58.5 million offering directly under the market's head.
Yeah, it killed the rally.
Exactly. I mean, think of it like a pizza. You have a pizza, and you just keep cutting it into more and more slices.
The slices get smaller.
Right. The pizza doesn't get any bigger. You just have thinner slices, so each slice is worth less. That dilution just completely destroyed that mid-April peak near $6.
It did.
So if they just destroyed their own stock price to raise this cash, what exactly are they doing with the money?
Well, management rarely dilutes from a position of power unless they absolutely have to, right?
Yep.
Institutional buyers aren't going to hand over $58.5 million without demanding a steep discount to the current trading price.
So it's about survival.
Basically, the market is aggressively repricing the stock today because that outstanding share count just ballooned.
Which brings us to the order flow we're seeing right now. I'm looking at the real-time quote, and the bid-ask spread is sitting pretty tight at $3.75 by $3.76. There's a very marginal after-hours bump, like up 1.35% to $3.76. But what really stands out is the volume clustering.
The defense.
Yes, exactly. There is this massive wall of buying interest defending the $3 to $3.70 range.
Defending is definitely the right word there. That $3.16 to $3.70 zone is acting as a critical support level right now. And the psychology here is just fascinating.
How so?
Well, the buyers stepping in at $3.60 aren't necessarily long-term believers. A lot of them are short-term momentum traders trying to catch a bounce off a psychological floor.
Right?
They're trying to prevent a cascading liquidation below that new $4.35 offering price. Because if the stock consistently trades below the price that the institutions literally just paid yesterday,
those institutional buyers are instantly underwater.
Exactly. And that creates a very toxic dynamic where the new money might panic and start dumping.
Wow. Okay, so we have to ask the big question. Why did they need $58.5 million so badly that they'd wreck their own momentum?
It's all in the financials.
It is. If you look at the income statement and the cash flow, honestly, it's staggering. I mean, look at the trailing 12 months and the full year 2025 numbers. Total revenue is only $3.38 million.
Right.
But their net income is a massive negative $29.47 million. Operating income is negative $28.01 million. Basic EPS sits at negative $1.19.
The cash burn is intense.
Yeah.
But, you have to filter those numbers through the specific economics of the space tech industry.
I'm trying, but here's where it gets really interesting. That translates to a net profit margin of negative 871%.
Yeah.
I mean, are they just burning rocket fuel on the launch pad? How do you operate when you spend nearly $10 for every single dollar you bring in?
It sounds wild, but it's somewhat normal for this sector. Developing proprietary hardware like their Fortis command and data handling system, it requires massive upfront capital.
I guess you're paying for engineers, clean rooms.
Exactly. You're securing launch windows long before a single dollar of revenue comes back. The lead times are measured in years. So a massive negative profit margin is actually the standard baseline for an early-stage orbital infrastructure company.
Okay, I see why you'd argue that, but let's contextualize this with the actual balance sheet.
Let's do it.
In Q4 2025, total assets were $66.09 million against total liabilities of $15.46 million, and their most recent quarter total cash was $43.18 million. So, on the surface, it looks okay.
It looks healthy until you factor in the velocity of their spending.
Right, the cash flow.
Yes. You have $43 million in cash, but their operating and net cash flow was negative $18.15 million.
Oh, wow. So they're chewing through over $18 million just to keep the lights on.
Which is precisely why that $58.5 million offering yesterday was a survival mechanism. It wasn't a luxury.
Huh?
If you're burning nearly $20 million in operational cash and you only have $43 million left, you were staring down the valley of death.
The valley of death.
Yeah, that's the phase in hardware startups where you run out of money right before your technology is ready for commercialization. They had to secure that capital to survive, even if it meant absorbing the wrath of their current retail shareholders.
So they basically chose dilution over bankruptcy.
Precisely.
That makes sense from a boardroom perspective, I guess. But let's look at how that decision is translating to the technical charts, because the chart right now is just a battlefield.
The technicals are definitely throwing mixed signals. What are you seeing on the trend lines?
Well, I'm looking at the moving averages, and my screen is basically contradicting itself. The stock is trading below its 50-day simple moving average, which is at $4.78.
Right, a classic bearish signal.
Exactly. It means short-term momentum is broken. But at the exact same time, it's staying above its 200-day SMA, which is way down at $3.25. And staying above the 200-day is a bullish signal. So you have a short-term sell signal colliding with a long-term buy signal. How should retail traders interpret this mixed message?
You have to separate the signal from the noise, really. The 200-day moving average tells you that the structural recovery from those penny stock lows, that $1.62 mark, is still intact.
So the macro picture is okay.
Right. But the breakdown below the 50-day average shows you exactly how much damage the dilution caused to the immediate psychology. When a stock is trapped between the 50-day ceiling and the 200-day floor, momentum just evaporates.
And the momentum indicators totally back that up.
They do.
The MACD, the moving average convergence divergence, is sitting at negative 0.218. It's flashing a clear sell signal.
Right. And instead of just looking at that as a negative decimal, think about human behavior. The MACD going negative literally shows that the buying momentum is exhausted.
The bulls are just tired.
Exactly. The people who wanted to buy the dip have already bought it, and the sellers have seized control of the near-term action.
Which aligns perfectly with the 14-day RSI. It's sitting at 42.76, showing this weird neutral to bearish weakness.
It's in purgatory.
Right. It's not low enough to trigger the oversold algorithms, but it's clearly drifting downward.
And that downward drift is dangerous. Below that $3.60 immediate support we discussed, the deeper trendline supports are way down at $2.50 and $2.31.
Ouch. And what about the upside? Where's the resistance if it tries to rally?
The primary resistance is an immovable psychological ceiling right now, $4.35.
Which is the exact price of the recent offering.
Exactly.
Because of the bag holders.
You hit the nail on the head. Anyone who bought into that offering yesterday, or right before it expecting a breakout to $7, is now holding a loss. The second the price hits $4.35 again, they'll sell just to break even.
So what does this all mean when we look at analyst ratings? Because here's where the data gets totally unhinged.
Oh, the analyst consensus is fascinating.
It's insane. Most analysts have a sell or a hold rating on the stock right now. They're clearly spooked by the short-term outlook, but the average price target from those very same analysts is $10.20.
This raises an important question, doesn't it?
I mean, how do you slap a sell rating on a $3.71 stock, but then officially publish a target of $10? That implies massive long-term upside.
It's a bizarre contradiction, but it brings us to a really dangerous concept, the value trap.
Let's unpack that. Retail traders get crushed by value traps constantly.
A value trap happens when a stock looks incredibly cheap, but is actually priced correctly or even overvalued because of structural issues.
Okay.
Look at their price-to-book ratio. It sits at 4.99. In tech, that's relatively low. It implies you're paying a slight premium, but a reasonable one, for their actual physical assets.
Right, they have real satellites, real IP.
But then you look at the price-to-earnings ratio, which is negative 3.07. Because of that negative profit margin, traditional valuation just breaks down entirely.
So the $10.20 target isn't based on today's reality.
Not at all. Analysts are running models based on the assumption that in 3 or 4 years, Sidus will dominate its sector.
And that is the trap. You log into your brokerage app, see the stock is down, see a $10.20 a target, and think it's free money.
But those targets don't account for the dilution journey it takes to get there. If Sidus burns through this cash and has to issue another 20 million shares in 2 years, the current retail shareholder slice will be so microscopic they still lose money.
Not to mention the short sellers. The short float is currently at 11.2%.
That's a heavy headwind.
Yeah, over 11% of the float has been borrowed and sold by people who actively believe the company will trend lower. So let's crystallize all this. Let's outline the ultimate bear case versus the bull case.
Let's start with the worst case scenario.
Right, the bear case, the slow, agonizing bleed.
Yeah, in this scenario, the heavy dilution has permanently bloated the float. The share price stays pinned down, that $58.5 million just gets swallowed by R&D, and that negative 871% margin barely improves.
Market sentiment stays highly skeptical.
Exactly. Retail buying dries up, the stock bleeds through the $3.60 support, crashes through the $3.25 moving average, and spirals right back down into the $2 range.
Okay, that's bleak. But let's flip the coin. What is the absolute best case recovery scenario? How do they validate that $10.20 target?
The bull case is anchored in their newly secured balance sheet. By raising that cash now, the fear of imminent bankruptcy is gone.
They have liquidity.
Right. Their engineering teams can focus purely on execution. They recently made updates to the Fortis MDA system. If they successfully deploy this tech and transition into a high-margin hardware provider, the upside is huge.
And we cannot talk about the bull case without mentioning the golden ticket.
The MDA contract.
Yes. This is what every bull on the message boards is screaming about. Sidus Space was officially selected for the Department of Defense's MDA SHIELD program, and the stated ceiling for that contract is $151 billion.
It's a staggering number.
But wait, let's push back on that. A $151 billion ceiling sounds amazing in a press release, but what are the actual odds of converting that into real revenue?
If we connect this to the bigger picture, it's exactly what makes the stock so volatile. The MDA SHIELD program is an IDIQ structure.
Meaning what, exactly?
Indefinite delivery, indefinite quantity. Winning a spot on a $151 billion IDIQ does not mean they won $151 billion. It's basically a hunting license.
Ah, so they just won the right to compete.
Right. The government is saying we have authorized up to $151 billion across dozens of approved vendors. Sidus now has the right to bid on specific smaller task orders.
They didn't win the actual money yet.
Correct. But even capturing a microscopic fraction of that ceiling would transform them. Winning just 1/10% is $150 million in revenue. For a company that made $3.38 million last year, that justifies the $10.20 price target instantly.
Wow. High risk, high reward. So to wrap up our short-term versus long-term outlook, in the short term, expect choppy volatility.
Consolidation.
Right, trapped between that $3.60 support and the $4.35 offering price as the market digests all these newly issued shares.
And in the long term, everything hinges on successful launches and actually monetizing that MDA contract.
Exactly. And just as a quick reminder, everything we've discussed is a debate of the data, not financial advice.
Like, do your own research.
Always. But I want to leave you with a final thought to mull over. The whole space industry is shifting, right? We're looking at Sidus burning cash to build hardware, but simultaneously, SpaceX is drastically lowering the cost of getting that hardware into orbit.
It changes the whole dynamic.
It really does. With a freshly padded war chest of cash, but a truly astronomical burn rate, will Sidus Space actually build the orbital infrastructure of the future? Or are they just building a bigger, more expensive bonfire for retail investors' money?
It's a tough call.
What stands out to you? Let us know in the comments.